Welcome back to AlgoBot, the channel where we take apart automated trading strategies and study how they actually work. I'm your host here at AlgoBot, and today we're examining an expert advisor for MetaTrader 5 called the weighted rate of change momentum cross. This strategy builds a single, smooth momentum line out of 4 different rate of change readings, then acts when that line crosses its own signal line on the correct side of zero. By the end of this video, you'll understand the indicator behind it, the exact entry and exit rules, and how it manages risk. Let's get started. And remember, this is educational information only. So what exactly does this expert advisor do? At its heart sits a composite momentum oscillator inspired by Martin Pring's summed rate of change family of indicators. A single rate of change reading measures how much price has moved over a fixed number of bars, expressed as a percentage. The problem is that one reading is noisy and depends heavily on the lookback you choose. A short lookback whips around with every wiggle, while a long lookback lags far behind. This strategy addresses that by blending 4 rate of change readings over increasing lookbacks. Each one is smoothed with a moving average, turning it into what's often called a smooth rate of change. And then the 4 are added together with rising weights of 1, 2, 3, and 4, so the slower, steadier horizons carry more authority in the final number. The result is a single, well-behaved momentum line. Because it leans on the long horizons, it stays calmer during trends, but because it still contains the fast horizons, it can turn earlier when momentum shifts. The strategy then builds a signal line as a moving average of that composite and studies the crossover between the two with an extra zero-line filter that we'll cover in detail. In terms of markets, the time frame is never hard-coded. The expert advisor reads whatever chart and time frame you attach it to, so it can be studied on hourly or 4-hour charts of major currency pairs, on gold, or on index contracts for difference. It's a trend-following momentum continuation approach on a single time frame, designed to lean into moves that already have momentum behind them rather than trying to pick exact tops and bottoms. This style tends to appeal to traders who prefer a systematic, rules-based process and who are comfortable holding through the natural ebb and flow of a trend. As always, this is a study of how the logic works, not a recommendation, and trading always carries the risk of loss. Let's walk through the mechanics step by step, using only closed bars so nothing repaints. On each new bar, the expert advisor rebuilds its 4 rate of change readings from the closing prices. The default lookbacks are 10, 15, 20, and 30 bars. Each reading is then smoothed with a simple moving average over the smoothing period, which defaults to 10. These 4 smooth readings are combined into the composite line using the weights 1, 2, 3, and 4. The signal line is then a simple moving average of that composite over the signal period, which defaults to 9. Now the entry logic. The strategy watches for a crossover between the composite line and its signal line. A long setup begins when the composite crosses up through the signal line. A short setup begins when the composite crosses down through the signal line. But a crossover alone is not enough. The strategy adds a zero-line gate. For a long, the composite must also be above the zero line, plus an optional buffer. For a short, the composite must be below the zero line, minus that buffer. This filter matters because low-conviction crosses tend to cluster around the flat zero line during choppy, directionless markets. By requiring the cross to happen clearly on the bullish or bearish side of zero, the strategy aims to skip many of those weaker signals. Both the long and short sides are fully symmetric. Before any trade is placed, a few gates must pass. Only one position may be open at a time per magic number. There must be a valid reading from the average true range indicator, and a cooldown of a set number of bars must have elapsed since the last entry. The default cooldown is 1 bar. When a trade does open, risk is defined immediately using the average true range, a common measure of volatility. The stop loss is placed a multiple of that range away from entry, defaulting to 2 times, and the take profit is placed a larger multiple away, defaulting to 3 times. That gives a fixed reward to risk shape of 3 to 2 by default. On top of that, a trailing stop follows the trade. Once price has moved 1 range unit in the position's favor, the stop begins to ratchet to a set distance behind price, and importantly, it only ever tightens, never loosens. That's how the strategy attempts to protect open profit while still letting a trend run. And of course, None of this removes risk. Losses are a normal part of any approach. Let's look at the actual meta-editor code that drives this. At the top are the input parameters. You can see the 4 rate of change lookbacks, ROC1 through ROC4, set to 10, 15, 20, and 30. Below them are the smoothing period and the signal period that shape the composite and its signal line, and the zero buffer that controls the zero line gate. Then come the risk inputs, the average true range period, the stop loss and take profit multipliers of 2 and 3, the trailing stop settings, the cooldown, the lot size, and the magic number. Now the core logic. The code reads the composite momentum line and the signal line on the last 2 closed bars, KSTNow and SigNow for the most recently closed bar, and KSTPrev and SigPrev for the one before it. From these it computes 2 conditions. Crossed up is true when the composite was at or below the signal on the prior bar and is now above it. Crossed down is the mirror image, true when the composite was at or above the signal and is now below it. Next, the zero line gate is applied. The long signal is true only when crossed up is true and the composite is above the zero buffer. The short signal is true only when crossed down is true and the composite is below the negative zero buffer. Finally, the 2 trade calls. If the long signal is set, the code calls trade.buy, with the stop loss placed at entry minus the range times the stop multiplier and the take profit at entry plus the range times the take profit multiplier. If the short signal is set instead, the code calls trade.sell, with the stop loss above entry and the take profit below it by the same multiples. Both sides are symmetric, and every decision uses only closed bars. Let's bring it all together on a chart. Across the top you can see price as candlesticks, and in the panel below sits our composite momentum line in gold, its signal line in blue, and the all-important zero line running through the middle. The green region above zero marks bullish momentum, and the red region below it marks bearish momentum. Watch how the 2 panels move together. On the far left, price is drifting lower. Each candle makes a slightly lower close, and down in the oscillator the composite line is sitting deep in the red, while below both zero and its signal line. There's no reason to act here. Momentum is clearly negative, so the strategy simply waits. As we move toward the middle, price stops falling and starts to base out. Notice the composite line down below. It is still under zero, but it has stopped dropping and begun curling upward toward its signal line. This is the moment the strategy is watching for, but it does not step in yet. Remember the zero line gate. Even as the composite climbs, it is still on the bearish side of zero, so no long is allowed. Then comes the breakout candle. Price pushes up with a strong bullish bar, and in the panel below the composite line finally crosses up through its signal line, and, at that very same moment, lifts above the zero line into the green. Both conditions are now satisfied. An upward crossover on the bullish side of zero. That is where you see the buy entry marker appear. The strategy opens along and immediately sets its protective stop a couple of range units below entry and its take profit target further above, giving that 3-2 reward to risk shape by default. Now watch the trade develop. The next candles rally cleanly. The composite line climbs higher into the green, staying comfortably above its signal line, which confirms that momentum is expanding in the position's favor. As price presses into new highs, it reaches the take profit target, and the long is closed for a gain in this illustration. Notice too that had price hesitated along the way, the trailing stop would have been ratcheting up behind it, tightening only, never loosening. After the peak, the character of the market changes. Price stalls near the highs and starts to roll over. In the oscillator, the composite line has topped out and begins sliding back down toward its signal line. Just as before, the strategy stays patient. The composite is still in the green above zero, so even as it weakens, the short is not yet permitted. Then the mirror image of our first setup unfolds. A firm bearish candle breaks price lower, and in the panel below the composite line crosses down through its signal line and drops through the zero line into the red at the same time. Now both short conditions line up, a downward crossover on the bearish side of zero. That is where the sell entry marker appears. The strategy opens a short, placing its stop a couple of range units above entry and its take profit target further below, once again in that fixed reward to risk shape. The final candles show the short working out. Price falls steadily. The composite line pushes deeper into the red below its signal line, and price reaches the lower take-profit target, closing the short for a gain in this example. And again, the trailing stop would have been following the position down, protecting open profit if the move had stalled. Step back, and you can see the rhythm of the whole approach. The strategy waits for momentum to genuinely turn, confirmed by both a crossover and a zero line. Then it defines its risk with the average true range and manages the trade with a one-directional trailing stop. It is deliberately patient around the flat zero line, which is exactly where weaker signals tend to appear. Of course, not every signal in real trading resolves this cleanly, and losses are a normal part of any strategy. That brings us to the end of our breakdown of the weighted rate of change momentum cross expert advisor. We covered the composite momentum oscillator built from 4 weighted rate of change readings, the crossover entry with its zero-line gate, and the range-based stops, take profits, and trailing logic that manage each trade. I hope this gave you a clearer picture of how a summed rate of change system is put together and how it thinks about momentum and risk. If you found this useful, please give the video a like, leave a comment with any strategy you'd like us to analyze next, and subscribe so you don't miss future breakdowns. You can find more educational content over at www.algobot.live. Remember, everything here is for educational purposes only and is not financial advice. Past performance does not guarantee future results. Trade responsibly.